Yield to maturity. When people look at a bond, one of the first numbers they notice is the coupon rate. Along with that, they also see a term or a percentage which is usually called yield or yield to maturity, YTM. This is a major part of investing in bonds. So let's understand what YTM actually means without turning it into a formula. Yield to maturity, YTM, is a number that shows the return of a bond is expected to generate based on its current market price and all its future cash flows, assuming two things. First, that the bond is held till its maturity date. Second, that the issuer makes all interest and principal payments as scheduled. In simple words, YTM tells you the annualized return implied by the bond's current price and its remaining interest payments, along with the final repayment of principal. What YTM is and what it is not. It is important to understand this very clearly. First, YTM is not a prediction of future returns. Second, it is not a guarantee. Third, it is a mathematical calculation based on the bond's price today and the cash flow defined in the terms. To see why YTM matters, let's take a simple example. Imagine a bond with a face value of rupees 1000 and a fixed coupon rate of 10% per year. This means the issuer pays rupees 100 as the interest every year, regardless of the price at which the bond is bought. Now consider three different situations. Situation 1, buying at a discount. In the first situation, you buy this bond at a discount. Instead of paying rupees 1000, you just pay rupees 950. You still receive the same 100 rupees of interest every year, and at maturity the issuer returns the full amount, which is rupees 1000. Because you have invested a smaller amount but received the same interest and the full principal back, your overall return is higher than the coupon rate. Because you invested a smaller amount but received the same interest and the full principal back, your overall return is higher than the coupon rate. In this case, the yield to maturity is higher than 10%. Situation number 2, buying at a premium. In the second situation, you buy the same bond at a premium. Instead of paying 1000 rupees, you're paying 1050 rupees. You still receive the same rupees 100 of interest every year, but at maturity, the issuer returns only 1000 rupees. Because you invested more than the face value, you receive the same cash flow, your overall return is lower than the coupon rate. In this case, the YTM, the yield to maturity, is lower than 10%. Situation number 3, buying at face value. In the third situation, you buy the bond exactly at its face value of rupees 1000. You receive rupees 100, the interest, every year. And at maturity, you receive rupees 1000, which is the principal. There is no gain or loss on the principal. In this case, the yield to maturity, YTM, is equal to the coupon rate. Bringing it together, this is why YTM is such an important concept. The coupon rate tells you how much interest the bond pays on its face value. The yield to maturity, which is the YTM, tells you the actual return you are effectively earning based on the price you pay today. YTM links the bond's market price to its expected return. As the price of a bond changes, YTM changes automatically. Even though the coupon stays the same, this is also why the two investors holding the same bond can have different yields depending on the price at which they are purchased at. One final point to remember is this: YTM assumes that the bond is held until maturity and that all payments are made as promised by the issuer. If the bond is sold before maturity by the holder, or if the issuer fails to meet its obligations, the actual returns may differ. Understanding yield to maturity helps you look beyond the headline coupon rate and understand what a bond is truly offering at its current price. Now that we have a clearer sense of what YTM is, in the next video, we will take a closer look at the different types of bonds.